I think what we're looking at from the bigger picture is we're now looking at the US becoming a part, from gold and silver is concerned, a part of the global reset that we're seeing now. And they've been like an anchor trying to fight this all the way. And I think we just reached the point where there's too much technology coming in now. There's the ability to value the gold price is being revalued globally, and that liquidity that you and I have tracked this for so long. That liquidity that was partially paper centric has been flowing ever so slowly, one day by day, month by month, year by year, to the point where the lines have crossed, and where the physical the price is being settled in the physical markets now. So it's impossible to not comply. And I think so. Yes, I think this is the next step. So I think, you've talked about ETF outflows. Yeah. And that's concurrent with COMEX outflows. And people talk about, well, look, yes, it's all to do with tariffs. And, we've seen these big EFP spreads. And no, the EFP spreads is simply because the paper markets are getting drained. Fantastic amount of, I make 5 o'clock in the morning phone calls to all my Asian desks, Chinese contacts, Indian contacts, Saudi contacts, etc., etc. And these desks, just every morning they say, hey, we're buying. Hey, guess what? The West's going to sell later. I think we saw that again today. The West's going to sell at the pit open. And guess what? We're just going to grab it. And so we've seen this ridiculousness, this absolute, to mind-boggling stupidness where Asia buys, the West sells. Well, trouble is, most of the open interest, the COMEX open interest, where you could go fool enough people to buy into that, sell short with you, pull a few bids, get them to take some profits quickly. Oh goodness me, we're going into hell in a hell basket. So I think while that has been going on, then literally that open interest, the 75% of all the oil traders really control that market. It's just pure speculation. It's why we got the volatility. Same guys that are running the gold and silver markets historically. It's just momentum traders, like 75, they don't care what the price is. It doesn't matter. They're not ever going to take delivery. It's nothing to do with them. This is just a paper trade. These guys have anchored their boat to Bitcoin now. Hey, to me, there's just not enough of these guys to take that bait anymore. And I think, so yeah, these guys are laughing their heads off and say to me in the 5, hey, we'll keep buying, but we're going to save some dry powder for when the West opens. Is there settling, and they're saying, and this is the Bank of England, and is saying, and the RBMA is saying, yeah, okay, but you can have it in 3 months. You can have it in 8, 10, 12 weeks.
The global financial landscape is undergoing a significant transformation, particularly in the gold and silver markets. For decades, these markets have been dominated by paper-based trading mechanisms such as futures contracts and exchange-traded funds, ETFs. These financial instruments allowed investors to speculate on price movements without the need for physical possession of the metals. However, a discernible shift is now occurring, with growing emphasis on physical ownership over paper representations. This transition marks a crucial turning point for investors and institutions seeking security in an increasingly uncertain economic environment. One of the primary reasons for this shift is the widespread concern about market manipulation in the paper, gold, and silver markets. Andrew Maguire, a well-known commodities trader and whistleblower, has long argued that large institutional traders have been artificially suppressing prices by short-selling massive amounts of paper, gold, and silver. By dumping large contracts into the market at strategically timed intervals, these traders have allegedly managed to push prices lower, creating an illusion of surplus supply. This manipulation has caused distrust among investors, many of whom are now seeking to hold physical gold and silver rather than rely on financial derivatives that may not be backed by actual bullion. Another significant factor driving this shift is the increasing economic uncertainty worldwide. Global inflationary pressures, debt crises, and geopolitical tensions have all contributed to a growing demand for tangible assets. Gold and silver have historically served as safe havens during times of financial instability, providing investors with a reliable store of value. With the world facing unprecedented monetary expansion and central banks struggling to contain inflation, many investors are turning to physical metals as a hedge against currency devaluation. Unlike fiat currencies, which can be printed at will, gold and silver retain their intrinsic value and cannot be manipulated by central banks in the same way. Central bank policies have also played a key role in the reemergence of physical gold as a preferred asset. Over the past decade, central banks around the world have been steadily increasing their gold reserves, a clear indication that they recognize the long-term importance of holding tangible assets. Nations such as China, Russia, and India have been particularly aggressive in their gold acquisitions, reducing their reliance on the US dollar and diversifying their foreign reserves. This trend highlights a broader shift toward a more commodity-backed financial system, where gold serves as a stabilizing force amid economic turbulence. The implementation of Basel III regulations has further accelerated the transition toward physical gold ownership. These regulations, aimed at strengthening the global banking system, have reclassified gold as a Tier 1 asset, placing it on par with cash and government bonds in terms of risk weighting. This change has significant implications for financial institutions, as it encourages banks to hold more physical gold rather than rely on paper gold derivatives. As a result, demand for allocated physical gold has surged, further tightening supply and driving prices higher. One of the most telling signs of this shift is the growing disconnect between the paper and physical gold markets. Historically, the gold price was largely determined by futures contracts traded on platforms such as COMEX and the London Bullion Market Association, LBMA. However, in recent years, we have seen a divergence, with physical gold commanding higher premiums in key markets such as China, India, and the Middle East. This divergence suggests that the traditional paper-based price discovery mechanism is becoming less relevant as real demand for physical bullion exerts greater influence on pricing. For individual investors, this changing landscape has profound implications. The emphasis on physical ownership means that those holding actual gold and silver are in a stronger position than those relying on ETFs or futures contracts. In the past, investors assumed that paper gold was as good as physical gold, but recent events have shown that this is not always the case. Delivery delays, increasing premiums, and shortages of physical bullion have all reinforced the importance of owning metals in a tangible form. Those who continue to depend solely on financial instruments may find themselves unable to access real gold in a time of crisis. The ongoing shift toward physical gold and silver is not just a short-term trend, it is a reflection of deeper structural changes in the global financial system. As trust in fiat currencies declines, more individuals, institutions, and governments are recognizing the enduring value of precious metals. Those who take action now by securing their wealth in physical gold and silver will be better positioned to navigate the uncertainties ahead.
But what they're offering you is a paper forward. That's what they're offering you. It's a paper forward, which you hope you better get that. So the point is, a paper forward says, yeah, okay, so really I can now, because it's technically NSFR compliant, I can then marry that forward off into New York because it's supposed to be a first-year asset class, but it ain't. A forward is not. But this is the scam right now, is you've got the ability to actually say, yeah, well, here it is in 3 months, here's the forward, and here we're backing it, the Bank of England is backing it, here, we'll even give it to you at a discount. What kind of nonsense is this? And then on the other side of the fence, you've got an EFP where you've actually somehow squared the issue because, yes, it can be shipped out later, because you're backed. I mean, on paper you're backed, but you're not backed physically. And so as much as we're seeing bullion flowing into the COMEX vaults, the New York vaults, we're also seeing these same guys pulling it out and shoving it out the other way. So you've got this craziness going on here. And So to me, this is, yes, the break point. It has to be the break point. It is technically a default because really, if you say you can't deliver and it's T+1 compliant, the Bank of England, I mean, half of the vaults, the listed vaults, what's it in the vaults in the UK is supposed to be LBMA vaults, Bank of England vaults is supposed to be half of it's only half of it's central bank owned. So why is it taking this long? I mean, I could go in there tomorrow and unload a trolley load for an immediate delivery. Why would I have to wait all this time for what's supposed to be there? It's actually supposed to be there because they don't want to give it up. They just know that this is why what tells me something is going on. They're going to have to revalue gold. They're going to have to revalue it. The COMEX has to become Basel III compliant. I think this all feeds into what you're talking about, the new Treasury Secretary coming in, looking at this situation. But Andy, we know we have empirical evidence to say if you are going to back US Treasury gold, if you are going to revalue, US Treasury gold, you need an audit. Well, hold on. We've got empirical evidence to suggest that there's a lot of double ownership. Whether the physical gold is there, I don't know. No one knows if it's physically there, but is it, how to what degree is it rehypothecated?
The ongoing transformation in global gold and silver markets is not just a reaction to short-term financial instability, but a reflection of a deeper, systemic shift in how wealth is preserved and valued. While Part 1 focused on the movement from paper-based trading to physical ownership, Part 2 will explore how this shift is redefining global trade, central bank strategies, and the potential for a revaluation of gold and silver. These changes have far-reaching implications, not just for institutional investors and governments, but also for individuals looking to safeguard their financial future in an era of uncertainty. One of the most significant developments in this shift is the growing realization that the US dollar's dominance in global trade is being challenged. Historically, the dollar has been the world's reserve currency, giving the United States an unmatched financial advantage. However, with inflation eroding purchasing power and debt levels reaching unsustainable heights, trust in the dollar is declining. Many countries are actively seeking alternatives, and gold is playing a central role in that strategy. The BRICS nations, Brazil, Russia, India, China, and South Africa, are increasingly turning to gold-backed trade agreements, aiming to bypass the dollar and establish a more independent financial system. The growing accumulation of gold by these nations is a clear signal that they are preparing for a future where commodity-backed currencies may replace fiat money as the primary medium of exchange. The decline of the dollar's influence is also evident in the actions of central banks, which have been aggressively adding gold to their reserves. In 2023, central banks purchased a record 1,136 tons of gold, a trend that has continued into 2024 and beyond. This is not a coincidence. It is a calculated move to hedge against currency depreciation and financial instability. Many governments are recognizing that in times of crisis, gold provides a level of security that fiat currencies cannot. Unlike paper money, which can be devalued at the stroke of a policymaker's pen, gold maintains its intrinsic value across centuries. This reality is leading to a quiet but powerful transition in global finance, where physical assets are becoming more important than digital or paper-based wealth. A key aspect of this transition is the looming possibility of a formal gold revaluation. Currently, gold is priced based on futures markets, which, as discussed earlier, have been heavily influenced by institutional traders and central banks. However, as demand for physical delivery increases and paper-based claims on gold become harder to fulfill, the market may be forced to acknowledge the true scarcity of available gold. This could lead to a massive repricing event, where gold's value is adjusted to reflect real-world demand rather than financial speculation. Some analysts suggest that if gold were to be fully revalued based on central bank reserves and global money supply, its price could exceed $10,000 per ounce. While this may seem extreme, history has shown that major financial resets often result in dramatic price adjustments for real assets. The implications of a gold revaluation extend beyond just investment returns. A higher gold price would fundamentally alter the balance of power in global trade. Nations with large gold reserves, such as China and Russia, would gain increased financial leverage, while countries that rely on fiat currency systems, particularly those heavily indebted, could find themselves struggling to maintain economic stability. The United States, despite having one of the largest reported gold reserves, has not conducted a full audit of its holdings in decades, leading to speculation that some of its gold has been leased or rehypothecated. If a revaluation occurs, transparency in gold reserves will become a crucial issue, potentially reshaping international monetary policies. In parallel with gold's resurgence, silver is also experiencing a shift in market dynamics. While gold has historically been the preferred asset for central banks, silver's industrial applications make it equally important in the modern economy. With the rise of green energy initiatives, electric vehicles, and technological advancements, silver demand is increasing at an unprecedented rate. Unlike gold, which is primarily used for investment and wealth preservation, silver is consumed in industrial processes, meaning that much of the silver mined today will never be recovered. This scarcity factor makes silver an attractive long-term investment, particularly given its historically high gold-to-silver ratio. If this ratio were to normalize, silver's price could see exponential gains, outperforming even gold in percentage terms. For investors, these developments present both challenges and opportunities. The biggest challenge is navigating the increasing complexity of the global financial system. With central banks and institutional investors accumulating gold at record levels, individual access to physical bullion may become more restricted. In many countries, premiums on physical gold and silver have already risen significantly, reflecting the growing difficulty of obtaining these metals at fair market prices. This trend suggests that waiting too long to secure physical holdings could prove costly. One strategy for investors is to consider alternative storage options. While many people store their gold in traditional bank vaults, there is an increasing risk that governments could impose restrictions on private gold ownership, particularly in times of economic crisis. Historically, governments have resorted to confiscation or forced sales of gold during financial emergencies. To mitigate this risk, some investors are turning to offshore storage solutions in jurisdictions known for strong property rights and financial stability. Countries such as Switzerland, Singapore, and the Cayman Islands offer secure storage facilities that provide an additional layer of protection against potential government interventions. Another important consideration is diversification. While gold remains the ultimate safe haven asset, silver offers additional growth potential due to its industrial demand. A well-balanced precious metals portfolio should include both gold and silver, with a strategic allocation based on one's investment goals. Some analysts recommend holding 2/3 gold and 1/3 silver to capture both stability and growth potential. This approach ensures that investors benefit from gold's role as a hedge against inflation while also capitalizing on silver's industrial applications. The growing movement away from fiat currency systems is a clear indication that the global economy is on the verge of a major transformation. The widespread accumulation of gold by central banks, the increasing difficulties in sourcing physical bullion, and the potential for a future gold revaluation all point to a new era in which tangible assets regain their status as the ultimate form of wealth. Those who recognize this shift and take action now will be in the strongest position to navigate the changes ahead. As financial markets become more volatile and economic policies grow increasingly unpredictable, gold and silver provide a level of security that cannot be matched by traditional investments. The time to act is now. Investors who understand the importance of physical ownership, diversification, and strategic storage will be best positioned to thrive in the years to come. The world is changing, and those who adapt to these new realities will be the ones who preserve and grow their wealth in the face of economic uncertainty. In conclusion, gold and silver are not just alternative investments. They are essential assets in the new financial paradigm. The transition away from paper-based wealth toward tangible stores of value is accelerating, and those who recognize this trend early will reap the greatest benefits. The opportunity to acquire gold and silver at reasonable prices is closing, and once the market fully adjusts to these changes, prices could rise dramatically. The time to prepare is now. Stay informed, stay prepared, and as always, keep stacking.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.